Welcome to XYPN Radio, where your host Alan Moore brings you into a community of fee-only financial planners who want to profitably and successfully serve Gen X and Gen Y clients. If you're ready to get the knowledge you need from leaders in your field, learn from forward-thinking advisors, and take action on your own goals, XYPN Radio is the show for you. Here's your host.
Hello, and welcome to this episode of XYPN Radio. I am your host, Alan Moore, and I am so excited that you have joined me today for a bonus episode called Alan and Kitces Unhinged. If this is the first Unhinged episode you're listening to, we do these once a month, and they are mailbag episodes where basically we just answer listener questions, and we really enjoy these because it gives us the opportunity to answer questions that we might not have answered before, or topics that we might not have brought up ourselves. And so we're really excited to be able to offer these. And so real quick, if you want to submit questions, be sure you can either email them to us at radio@xyplanningnetwork.com, or you can join our VIP community at xyplanningnetwork.com/VIP, where you can post questions to the forums and get answers from other listeners in addition to our guest, as well as Michael and I, and hopefully get on the episode. So today we are talking through 6 questions, actually. The first one has to do with niche expertise and actually developing the expertise to serve a specific target client. The second question is the compliance and regulations around bringing on an investor or a partner into your firm that is not an actual financial advisor. We move on and talk about selling monthly retainers and selling financial planning to younger clients and the process that goes into that. We then had a discussion around the AICPA organization and the CPA/PFS, or the Personal Financial Specialist designation, and how it matches up with the CFP, the differences, similarities, and for younger CPAs out there that are looking to get into financial planning, which direction we recommend they go. We then had a quick discussion around e-signatures and the custodial relationships there and things you can do in order to get electronic signatures, why you should use them, the different systems that are available, and who accepts them. And then we close out with a really powerful question that got asked around strategies to get through the highs, but also the lows, the valleys of entrepreneurship and business ownership, and when to throw in the towel, and how to make the decision that, this may not be working. So those are the 6 questions we will be discussing today. So thanks again for joining us. And again, you can submit questions to us at xyplanningnetwork.com/VIP. Now, this month's episodes are brought to you by TD Ameritrade Institutional, which provides comprehensive brokerage and custody services to more than 4,000 fee-based independent registered investment advisors. You can learn more about what TD Ameritrade is working on in episode 23 at xyplanningnetwork.com/23. So without further ado, here is Michael and myself on Alan and Kitces Unhinged. Hey, Michael, you ready to get started on today's mailbag episode?
I think so. I'm never quite certain because for those of you who don't know, Alan truly does not share the mailbag questions with me in advance. So I'm always wary to say, I'm totally ready, because I really don't actually know if I'm ready or if I'm just going to kind of wing it as we go and try not to embarrass myself. Well, I guess that's pretty much the reality. I'm going to wing it as I go and try not to embarrass myself. And hopefully we'll talk through some good questions today.
Yeah, it's really fun. So for anybody that doesn't know, Desi is our kind of podcast manager. And so she collects all of the questions and remits them to me really just 20 or 30 minutes before we record. So I hardly have a chance to actually look at them. But what I like about this and why we call it Alan and Kitces Unhinged is, one, Kitces doesn't get to go by his first name. And 2 is because this really is just, let's just ask some questions and almost fireside chat if we were looking to be a little less extreme with the name. But we have a lot of questions today, so we're going to do our best to jump into these. And kind of glancing down through here, there are actually some that'll move a little quicker than some of our riffs in the past. So should be fun.
Yeah. So there are some questions here that is actually like, I will answer yes or no, and that will be that, and we'll move on to the next one.
I have never heard either of us answer a question with a simple yes or no, but we can do our best to try.
We can try. We'll see how it goes.
We could do like yes or no episode. Submit your yes or no questions, and we just answer yes or no for an hour to a bunch of questions.
I almost kind of want to try that just for the maybe sheer amusement of it. I don't think that can be a regular thing, but it probably works once as a novelty,
might be fun once.
Right? Yeah. All right. So what do we have?
All right. So we're going to start off with a topic that we never talk about on this show, and that is niche marketing. Ideas for how one would go about gaining the expertise for a narrow niche prior to or when launching their firm. You can certainly do market interviews, design a practice around serving veterinarian selling practices or airline executives with pensions that have specific needs. But if you're trying to break into this market, how do you prove or demonstrate expertise versus just marketing to a target client?
So how do you get the expertise? Well, so I think the person kind of mentioned it there as the starting point. So in order to get the expertise, first you have to figure out what the expertise is you're trying to get, which means to me, it really does start with something like market interviews. And, for those of you who read Nerd's Eye View blog, I did an article about this, I think it was earlier this year, about kind of how you find and refine your niche. And the basic formula is pretty straightforward. Find about 10 people in this prospective niche that you want to work your way into. Hopefully, maybe you've got some connection to some of them already, just so it's a little bit of a warmer ask. And you're going to contact them. You're going to ask them, can I take you out to lunch? I'm working on building a business to help people in situations just like yours with their financial issues. And I'm just trying to do some market research and interview some people to find out a little bit more about what they need, what they would even want from a business like this. And, you ask 12, 15 people, many of them will probably take you up on a free lunch and help someone out, particularly if you've got any kind of personal connection or introduction to them. And you're going to ask them, you're going to find out, what are your challenges? What are your issues? What are the things that you struggle with? Frankly, what you're really looking for is stuff that has nothing to do with the classic CFP curriculum and the typical products and services that we sell, because they can get that from anybody else. You're looking for the other stuff, right? So if you're talking to lawyers, you might find out that how you do partnership negotiation deals and buy-in for a partnership might be a big thing you have to deal with. You're talking to young doctors, it might be student loan debt issues. Frankly, if you're talking about, I think you mentioned veterinarians in the question, you might be talking about, again, things like student loan issues, buying into a veterinary practice, how you staff it, what an office manager looks like. I don't even know what the reality is of running a veterinary business. So you're going to get that information from them about what their struggles are. And that's going to tell you what it is and where you need to go. If you find out that the biggest issue for veterinarians is they're just all screwed up about how they run their practices, you're going to go out there and you're going to find any information you can on veterinary business succession planning and find whoever it is that's got stuff about it and read their stuff and learn about it and teach yourself and proceed down that road. And I mean, that's what it is for almost anything that you're going to move into for a niche. I think, if the clearest definition or like the clearest hint that you're on a good track for your niche is when there is no standardized curriculum for the things that you need to learn. Because that means what you're doing is so completely unique and differentiated. No one has tread down this road before, which means as you go out there to gather all the different information to build that expertise about what it is by going one at a time to research whatever their issues are and bringing all that together so that you are now the country's leading expert in young veterinarians because you have pulled together all those topics into a cohesive unit. Like that's what defines your niche and expertise. So I guess like it's kind of a, drag it out, go right to the source of whatever those issues are and research it. I mean, however you're going to research whatever it is you're trying to get into. But first you got to actually ask the people so you know what the heck you're searching for.
Yeah, I think this question really gets to the point that a lot of advisors kind of find their niche naturally, I would say, just by the clients that are coming to them. So Scott Oath out of Minneapolis just started working with target executives, became an expert in target executives, and then more target executives started showing up. And now that's a huge percentage.
You don't mean executives are his target market. You mean he actually works with the executives of the company target.
Of Target Corporation, yes.
Yes.
And so that has become his niche, as opposed to kind of this question is asking, well, what happens when you go to launch a firm and you want target executives to be your niche? I would say it is a little bit of a challenge. It's a little different when you have a client come to you, you're going to have access to information that you simply can't get without working with a client already, such as access to information about their pension or their 401k. And so while you can get, line of sight on some of that, maybe not all of it. So
I think it just makes the point, if you want to go after a target market, you're going to have to target it. Now we're like your target market, you have to target. Should have gotten a better example, Alan. But like, that's the point. So, okay, well, what can I do to network my way to some executives? What can I do to get my foot in the door with HR at Target so I can get my hands on some of their employee benefits information? Can I work with some other people at Target who are maybe middle managers just so I can get my foot in the door? Like, if you're really going to pursue this strategy, just like pause everything else. Like, okay, my goal, notwithstanding the fact some other advice is already in the space, but like if my goal is I just want to be the leading expert in the executives at Target, like you can actually sit down and figure out like truly what would your tactics be? All right, I'm going to start looking for information online, right? Because a lot of executive compensation stuff is disclosed in public documents. It's a publicly traded corporation. So I'll start reading about that stuff and learn it. Maybe I'll try to figure out how I get my foot in the door with an HR. Maybe I start looking around my LinkedIn network and like, do I know anyone who knows a Target executive, even if it's 3 degrees of separation? You can actually start formulating the strategy. Who would I try to reach? Who are the people who are in the know? That's what we commonly call centers of influence, right? Like in the world of Target executives and the people that administer their benefits and the people that do their compensation, all the rest, who are the centers of influence? How can you network your way to them and get to them? Like that's actually the point of being targeted. And while it may feel distant to be figuring out how on earth do I get to these Target executives, to me, it actually brings an incredible focus. Because I'm thinking about exactly like who would I go to, what groups would I want to reach to, what do I have to network through in order to get to the thing that I'm trying to get to. When you say I want to work with any executive on the planet, the good news is now you've got access to like 50,000 of them instead of a couple dozen at Target. And you're probably even more lost about how on earth you actually get to them. Because with the focus of the niche becomes a focus about how you can acquire and dig in and go after a segment.
And I know we beat the drum around niche marketing, and I promised anyone tired of listening to us rant about it, I don't think we have any more niche marketing questions today, but these are things that very, very, very few advisors talk about or ever think through. And it's something that we talk about it like it's normal and like this is something every advisor does. But you have to understand what Michael just described is not normal. Very few advisors do that.
And that's the problem. Like the advisor world, like we all get stuck in this same trap. I mean, I literally call it the biggest trap in advisor marketing, which is that we think we have to cast the net as wide as possible. Like, why would I go after Target executives when I could go after all executives? Because if you go after all executives, you're going to spin your wheels in circles trying to figure out how on earth you reach any of them. And if your singular focus is Target executives or pick any other corporation, large corporation you want with a critical mass of executives, you can become so much more focused about who you're trying to reach. And when you're a Target executive and you get this meeting for the first time with you, the advisor that specializes in them, I specialize with executives. Like, okay, well, I've heard that before because a lot of people pitch me. I specialize with Target executives, and I can tell you more about your employee stock options, restricted stock, and deferred comp than you even know. All right, well, now you kind of piqued my interest, if only because I want you to prove that. And then if you prove that, now I'm actually trusting your expertise, and we're going to a whole other level. And I went through, like, personal story in this. So I went through this an event a couple of weeks ago. So I was speaking at an event for Pinnacle, which is my advisory firm with several other partners. So notwithstanding our XYPN focus here on working with younger folks, Pinnacle is actually a firm that works with baby boomer retirees. That's kind of our focal point. We're very much the traditional RIA, managing assets, doing financial planning for baby boomer retirees. And of course, as a firm that's been around for over 20 years, we're $1.8 billion under management, over 1,000 clients. So like we're focused with baby boomer retirees, but we got a pretty wide range because it's just inevitable. And, at the point that we have like 15 advisors and almost 50 employees, like we could pretty much handle anybody that comes in. So I'm at a marketing event. It's us and 2 other advisors, 2 other RIAs from the area that I know and respect. I don't have anything negative to say about them. We're all up there to talk about tax planning and estate planning strategies. That was kind of the premise of this event. Large organization brought in a whole bunch of their clients who could be our clients. We were brought in, 3 of us, to talk about tax and estate planning strategies to try to, show off our expertise so that these folks might want to work with us. And I have the room. They had to be fairly affluent to be in the room, but anybody from pretty much the age of like early 40s to late 70s was in the room, maybe 50 or 60 people. So my 2 compatriots go first in the introduction process. And the first one stands up and says, I'm so-and-so. Our firm does investment management and financial planning. We do customized, individualized solutions for all of our clients. Our firm has been around for 27 years. We have $1 bajillion under management. I have multiple credentials and I'm a deep expert. And I will be talking to you about tax and estate planning. I'm looking forward to the session today. And he sits down. And then the next person stands up and says, we are a very similar firm. We have $1 bajillion under management. management. We've been in practice for 32 years. We have a national clientele. We're able to work across a very wide range of people. We have, executives that are still working, small business owners, and affluent retirees, basically saying like every possible category of people who have money. And he goes through and, we have deep expertise in customized solutions. And I look forward to talking about tax and estate planning. And so recognizing like this is the classic, we're all firms that do everything for everyone. I was third in line. I stood up. I said, I'm Michael Kitces. Michael Kitces. No, I actually said
did you just mispronounce your own last name on stage? That would be great.
I'm so passionate about this. No, I got my name right at the real time. I only can't do it at a podcast recording. So I said, I'm Michael Kitces. Oh my gosh.
Did it again.
I am Michael Kitces, partner and director of research for Pinnacle Advisory Group. We're a wealth management firm here in the Baltimore, Washington area that specializes in retirees. We take a deep focus on coordinating the liquidation of retirement plans, the timing of Social Security, how to manage portfolios effectively through market volatility, and we have a component of tax and estate advice through all of everything that we do for our retired clients, which is what I'll be talking about today. So all my compatriots do everything for everyone. We work with retirees. We specialize in retirees. Now, I'm sitting in a room with about 50 or 60 people in the audience. I have probably killed a third to a half of the people out of the gate because I can clearly see they're in their 40s or 50s and like maybe one or two of them are going to retire early, but clearly they're too young. So we go through the whole session and we do our thing and everybody's sounding good up there. And we get to the end of the session and my compatriots turn to each other and shake their hands and say, hey, it was great to meet you. And I get swarmed by 4 people, all of whom are in their early 60s, who say, your stuff was great and we are about to retire and can I have your business card? One after the other, after the other, after the other. And the reality is any of the 3 of us up there could have worked with these clients. But the clients identified with the person that specializes in retirement because that's their problem. I had an instant connection to them when I said I specialize in their problems. And while it's true, I didn't get the other 56 people in the room.
Neither did the other guys. Yeah.
The other guys next to me got 0 business cards. I got 4. Now, I only got 4 out of 60, and I crossed out half the room out of the gate with my qualifying statement. But I got 4 out of about the 30 that I could possibly work with. They got 0 of the 60 they can work with. And like that is, to me, is just the essence of what happens when you declare a focus. I was never going to have a chance for all 60 in the room. And if I said I worked with all 60 in the room, no one believes me. When I said I specialized in a group, some of them had a moment of need. That's why they were at the event. They were looking for someone that specialized in their problems. I said, I'm that person. I get 4 prospects. Everybody else gets none. And that's the dynamic. Like that's how niche works.
Which is amusing because to say we work with retirees, I would not consider that a niche. I would find that entirely too broad.
Actually, it really is actually a very broad niche. But when my compatriots said they had
work
no
with
niche,
everybody.
all I had to do was go retirement, and I was instantly more focused, differentiated, and able to create a rapport with the others. If they said they had worked with retirees, I would have said, well, we work with early retirees in their early 60s who are transitioning into retirement and are trying to figure out the timing of transition of their Social Security benefits, when to start them, how to get started on Medicare, how to bridge the health insurance gap from their retirement date until 65. And I would have taken a hyper-focus and said, no, what I want, we specialize in early retirees making the transition in their early 60s. So I would have differentiated from all of them again. And I know that version works because people in their early 60s who are transitioning in retirement are the ones with money in motion, which kind of helps because we're an assets under management firm. So I'm instantly differentiating myself with a segment of people who actually will have a need to work with me, who can rely on my expertise and have a business opportunity because I know they're going to be experiencing a transition event.
So the moral of the story is if you're ever on a panel, always introduce yourself last so you can be the one who actually gets to niche yourself. But you'll hear me say it and I'll say it again and I'll keep saying it. Marketing, good marketing, great marketing should repel more people than it attracts. You only need 40 to 100 clients. You only need 4 out of the group of 60. You don't need all 60.
And if you try for all 60, you're probably going to strike out all 60.
All right, so moving on to question number 2. In relation to partners, what guidelines are there and what regulations exist for investors that are not actually practicing in the business and are only providing seed money or investment funding? So It's kind of funny that this question came up. So basically, this advisor has someone that wants to invest and help start the business, but is not a advisor themselves and does not want to be. They simply want to provide capital. And I had the opportunity to speak with a compliance person about this exact topic for a different advisor. So it's kind of funny that this came up. And the answer is, it depends. It is a state by state. Yeah, I'm sorry to tell you, you're going to have to talk to your state regulator because every state is different. So some states require all investors or equity partners in an RIA to be registered at least as an IAR. Now, that means that you've got to get your investor to go out and pass the Series 65. If they are an investor, it means they have money, which means they are smart enough to pass the Series 65 because it is the easiest exam you will ever take for anybody that's out there. But so you may actually have to go through that process, but many states do not require them to be an IAR. It'll probably be outlined on the ADV and disclosed and that sort of thing. So it is state by state. Do you happen to know off the top of your head if the SEC requires it? I did not bother asking that.
I don't know offhand, but I'm 90% certain it is not necessary in the SEC context, because frankly, I can think of many large advisory firms I know out there that I'm virtually certain have investor partners who are not IARs, not the least of which a lot of large RIAs that end up selling off a part of their business in order to monetize for the founding owners often sell to people that are not necessarily practicing in the business. I doubt every private equity dude that bought an SEC registered RIA is actually an IAR of that RIA. So I don't know. Maybe they actually do all have to get registered. There has to be a point person, but I don't think so for SEC registered advisors. I'm sure the ownership interests have to be disclosed on the ADV, but I don't believe you actually need to be an IAR at that point.
Agreed. So I'm pretty sure that's how it works as well. But some states just simply have it outlined that they want to see, every owner registered. So you'll need to check with your state, but chances are probably not. All right. Next question. How do we get prospective younger clients to value a monthly retainer or monthly subscription commitment for a service like financial planning that they've never had before? While it may be a simple outlay to other monthly bills they have, I'm not sure that that's enough to convince them of the value. Basically, how do we sell the value of monthly financial planning to young clients? Any thoughts on this?
So two things come to mind to me offhand. Number one is you have to create a way to illustrate the value. So how are you actually going to show it? And number two, that kind of relates to it is, do you have a market, do you have a target market clientele that's clearly defined enough that you can illustrate it in the first place, right? So to me, one of the biggest problems that we have, and leave it to me to take the non-niche marketing question and bring it right back
make
to
it a niche marketing.
And make it a niche marketing question. But this is the point, right? So how do I make this compelling to young people when I could work with any person on the planet who's under the age of 35 and defined as a millennial? Honestly, I don't quite know how you define that very effectively. I mean, I think you can come up with a list of services that you're going to do. I've written in the past about actually creating a client service calendar that says, kind of paint the picture for them. Here's what we do. So you have an actual grid of a calendar, maybe monthly, not all 365 days, but a 12-month grid. And, on these 4 quarters, we're going to have a check-in call for 1 hour where we're going to talk about, in the fall, we'll talk about employee benefits. In the spring, we'll rebalance your portfolio. And in the summer, we'll look at your life insurance. And in the fall, we'll talk about what you're doing with your career and your cash flow and budgeting. Then in the off months, you'll get my client newsletter. In these time periods, I'll review your tax return in February. You come up with a lineup of stuff that you're going to do. You don't necessarily have to have something in every single month, but you might very well end out with something every single month. Some will be more intensive, some will be less intensive. But now the person kind of sees, here's all the stuff we're going to be doing over the span of a year to justify this ongoing fee that you're going to be paying. But the problem when you do the everything for everyone thing is that the boxes are going to be really generic, right? Because you don't know when their stuff's going to come up and you don't know what their particular problems are. So it's going to be much blander. If I go back to the target executives, all right, well, now it gets interesting. In October, we're going to talk about your employee benefits because I know at your firm, the deadline for doing all your employee benefits registration is at the end of October, and at the beginning of October, HR sends out the packet. So we'll have it within the first week of October, and we'll be talking to you about it then. So I'm demonstrating demonstrating I've got expertise in your company. I know how it works and what the timing is. And I'm going to dive right in. Then in December, we're going to talk about your deferred comp elections, because I know that all the executives at Target get deferred comp decisions that they have to make in a narrow window from December 15th until December 31st. So we're going to talk about then. Then in February, I'm going to do a review of your tax return, because I know you're going to be prepping it at that point, and it wouldn't do any good to have it out earlier because a bunch of the K1s from some of your private businesses don't come through then. So like I can start making something that's so much more targeted and relevant when I have a clearly defined target market. Right? Like if we're talking about veterinarians, I'm going to be talking about the timing of when your veterinary practice wraps up. If I'm talking to a lawyer, I might be talking about other time points in the year. If I'm talking to a person who lives something related to the accounting world, I know and we have no meetings in March and April because you're doing tax returns, and we have no meetings in early October because I know that you're doing extensions. So the more targeted your market is, the easier it is to come up with this unique differentiated list of items that you can put on an annual service calendar to show people what you're going to do. So show them what you're going to do, actually paint the picture for them, and ideally be targeted enough that the picture you paint for them clearly resonates with them. They don't look at it and say, but half the stuff on this calendar doesn't apply to me. And you're like, oh, well, because this is my generic calendar for every client who has no similarity to one another.
Yeah, I mean, this comes down to your ability to sell financial planning. And I think that it is a struggle. And this question specifically is pertaining to monthly subscription. I know there are some questions regarding if I charge monthly, do I have to talk to my clients monthly and all of that, which, I definitely don't believe. I think really what we're saying here is, how do I sell financial planning on an ongoing basis? And historically, we have been able to, in many ways, hide behind complexity. We've been able to hide behind the fact that we could sell on investment management, and we had this secret sauce, and we had all these things that only we knew and all that we had to do. And so selling investment management, I think, is a lot easier than selling financial planning, because as this, asker notes, they've never experienced financial planning before. So how do you show them what it's going to be? And I think you're absolutely right that being able to outline this is exactly what you're going to get for your money is a huge value. I think another option is an entry level service. So, we had Brittany Castro on talking about building e-courses to showcase her financial planning knowledge for her niche market. We've had Sophia Berra and Mary Beth Storjahan and Eric Roberge. I think Katie Brewer does this. Matt Becker. Pretty much every advisor offers some sort of one-time service offering. So if you have clients that are saying this financial planning thing kind of sounds squishy, I don't really understand what you do or how you do it or why it applies to me, maybe show them using a smaller service model. So instead of saying, hey, you're going to, sign on for $1,000 up front, $150 a month, and this is all the stuff you're going to get, maybe say, look, for $400 or $500, we're going to sit down and we're going to tackle the one thing that I know is stressing you out, because to your point, Michael, we're identifying our target market. So let's go back to Daniel Wren, who specifically focuses on residents that are becoming doctors. He can go in and say, hey, this is the ongoing service model, and I know it's a big commitment, and I know it's something that it's kind of scary to sign on for, and all of that. So for $500, I'm going to review your student loans, because I'm the expert in highly compensated employees paying off high amounts of student loan debt. That is definitely an area of specialization, even within student loan expertise, is high income, high debt needs. So he can sit down for $500 for 90 minutes or whatever the service model is and showcase, this is what I do and this is how I do it and why I'm worth the money, because I'm an expert in this. I'm getting to showcase that, and he's getting paid to essentially market himself. And you have a great blog post on this from a while back we can link to in the show notes. And I always point people in this direction to that blog post whenever we talk about this, because that is a way to show value without, basically getting married on the first date, because that's kind of been our sales model of sit down for prospective client meeting. By the end of the hour, they're going to be turning over their life savings to you and talking about money, the most sensitive topic of all time. It's kind of our last cultural taboo that we're going to talk about, money with this person after getting to know each other for an hour. Maybe give them an easier entry point, a lower entry point that's easier to manage. It's lower cost, but allows you to provide a ton of value.
And the one other thing I would note to this as well, a book I'll actually recommend, and we can link to this, the show notes as well. I wrote a review of it earlier this year called Selling the Invisible by Harry Beckwith. So this was actually a book that came out about 20 years ago and is still incredibly relevant to the modern environment. So Harry Beckwith is a marketing and PR guy who talked about like this fundamental challenge, how hard it is to sell an invisible, intangible service. So he didn't write specifically for financial advisors, but for almost anyone in some kind of professional services struggles with this, right? When I go buy a product in the store, like I can pick it up and weigh it in my hands and turn it over and look at it and see how it feels. I can take it home, play it with a while. If I don't like it, I can take it back. I can't do that with an intangible service, right? I don't know if I'm going to like it until after I paid for it and gone through it, and I'm kind of hoping it turns out okay. So it becomes very challenging to sell the invisible. And so one technique for this is kind of what I've talked about. The more you can paint a picture and turn something invisible into something a little bit more tangible helps. So like, it's not just about describing what you'll do for the year. It's about actually making a physical document part of your marketing collateral, your marketing materials. That is this like annual service calendars. You can hand someone a thing and they can pick it up in their hands. They can see it with their eyes. They can take the information in other ways than just hearing it. And they can try to turn this into something that's a little bit more tangible. But the other reason why I bring up Harry Beckwith is he makes the interesting point as well that in a world where we don't actually know very well how to evaluate an intangible service because we've never experienced it, it becomes all the other little things become even more important. Like this is why having a good website matters, and having a smooth process when you communicate with clients matters, and giving them a good experience even when they're contacting you as a prospect, because you're actually setting essential first impressions in a world where at the end of the day, they're not going to know if they should pay you for financial planning services until after they've paid you and decide whether they regret it or not. So when you're trying to communicate to them up front and make that connection, all the little things that frankly maybe some people wish didn't matter actually matter. They matter a lot. They matter overwhelmingly because it's one of the only cues that a prospect has to go on. So all the other little things about how to make a good first impression like really matter.
They get amplified.
Dramatically amplified.
Yeah, I mean, you can go back and listen to episode 2, XYPNetwork.com/2, where we had Carl Richards on. And I don't necessarily recommend this approach because Carl is a gifted communicator and a gifted salesperson. I'm not sure he would say it that way, but he really is. He does the initial plan development for free. I mean, and he talked through his process in that episode where he literally goes through the intro meeting, discovery meeting, plan presentation meeting, and he doesn't charge for that. He never has. And so at the end of the plan delivery, he basically says, would you like to work with me? And that's how he shows value without some of these issues.
He just actually does it.
He just does it. And
yeah,
so,
that reminds me of another book I would actually recommend in this context as well. We're just going to give people like a giant list of reading materials. Very good book called Getting Naked, not the dirty kind.
Or Naked, as we like to say in the South.
Naked, by Patrick Lencioni. And it's a very powerful book that talks about how to build instant connections with clients. And basically the way that you do it is you make yourself immediately vulnerable by just trying to give away value immediately from day one. He talks about this process. So Patrick is a consultant, and he talks about this process about how he built his consulting business, where he used to go through all the dynamics of like, you try to give them a little value, but not so much that they're getting it for free. And then you try to, dangle that there's more value out there and do that back and forth thing to try to get them to come on as clients. And he got hired into this new firm that was having incredible growth. And the way they did it was completely different. They just showed up at the first meeting with clients and immediately tried to give them value. Like, I'm going to pretend in the first approach meeting, you've already hired me and you're already paying me. And I'm going to do as much as I can to deliver your immediate value on the spot. Because what ends up happening most of the time is you demonstrate the value that they have no idea how else to assess for an intangible, invisible service. They see the value because they experience it immediately. And while most of us worry like, yeah, but if I start giving away my value for free, are they not going to want to pay me because I'm giving it away for free? And the reality actually are maybe like 1 out of 100 people are bastards that will do that. The other 99% are just like, I feel indebted to this person because it's already doing things that's so helpful. I want to hire them to basically like repay the debt and get this awesome ongoing value. So rather than hold back, like, you put it all on the table. You get naked, get vulnerable as a advisor or consultant. You put it all out there in the first meeting, and you'll find overwhelmingly that people so appreciate the value they're getting out of the gate. Like, why wouldn't I just immediately hire this person and continue working with them. I see the value because I got it in meeting one. I didn't have a meeting about the value we're going to have in the next meeting. I just got the value in meeting one.
Because truth be told, if you can give away all of your value in a 1 hour meeting, you're not worth paying for. So, and I know advisors are simply not in that boat. So, okay, so this next one should be interesting. This is not an area of expertise for me, but it is for you. So,
unlike all the other questions we've done so far, which were completely uninteresting.
Well, we'll see what you think. I'd like to know your opinion on the CFP designation versus the AICPA-sponsored PFS designation. Given the AICPA's track record of brand support, what do you think about the future of both brands, and do you personally believe the two designations are equal? Now, this is something that we dealt with whenever we launched XY Planning Network, because we did decide to use the CFP designation as the requirement to be listed on our Find an Advisor profile, and that the CPA/PFS designation, which I guess we can describe how someone comes to get the PFS designation, would not substitute for the CFP. NAPFA went through this just a couple of years ago, where they dropped the ability for CPA/PFS to be listed on their site and only went with a CFP. So you're fairly involved in AICPA. So can you talk just a little bit about the differences and what you think about the two designations?
Yeah, so a few things. So kind of first and foremost, so the PFS, which stands for Personal Financial Specialist, in order to get the PFS, you have to actually be a CPA, like a currently valid licensed CPA. So if you're not a CPA financial planner, if you're not coming in as a CPA financial planner, this is basically going to be off the table for you from day one. Now, that aside, so putting that aside for a moment, if you are a CPA, like which one would you pursue or how do they compare? So educationally, they're actually pretty similar. In fact, if you look at the underlying PFS educational material, it's basically the core 5 classes of the CFP marks, just kind of rebranded under the PFS end. It does not have the separate capstone requirement that applies to the CFP.
Which is fairly new. I mean, that only happened like 3 years ago.
Yeah, only happened a couple of years ago for the CFP marks. Although, frankly, there are a lot of folks out there who now make the case, well, that basically means the CFP education is now at a higher level than PFS, because you actually have to kind of step up and do the capstone course. You got to do it. Yeah, it's one more course. It's only one difference, but you do have to do one more course. And in fact, for the past several years, even if you were a CPA who had a PFS, you couldn't even challenge for the CFP exam because you had to go back and get the capstone course first, which kind of makes the point, like, these aren't even anymore if your PFS can't even challenge for the CFP exam. And they just people are just recently changed that to say, if you've been a longstanding practicing CPA PFS and you submit a financial plan to demonstrate your expertise and that you already have done the equivalent of the capstone in practice, you can get out of it. But there is a little bit of a difference on the education end as a starting point. Now, to me, the greater challenge that goes along with this is just kind of projecting this forward I'll start actually going the other direction. So historically, frankly, I think the average PFS was probably a good deal ahead of the average CFP. If I go back like 20 years, where the CFP marks were still getting going, we only added the CFP comprehensive exam a little over 20 years ago. So in the world where 20 years ago, a CPA PFS had their CPA credentials, had passed the CPA exam, and had then gone out and gotten their CFP education equivalents and got their PFS, I think it was fair to say the average PFS was probably a good ways above the average CFP, who took a couple of undergrad courses, didn't even have an exam, had very little experience requirements. Like, there was a big gap. But I think that's shifted, and they're probably at least approaching a much more even ground, even keel, at least on financial planning educational knowledge. Certainly, a CPA still has way deeper of an educational background in things that accountants do. They may at least be somewhat deeper on taxes than a CFP is, although just because you're a CPA does not actually mean you're a tax expert. CPA is primarily about accounting. It's got a heavy focus on auditing. There's a bunch of CPAs who've been on corporate finance and don't know anything about taxes. Not to bash CPAs, but just like CPA is really, really broad. It does not equate like CPA equals individual personal tax expert, even though many of them happen to be in that space. So in the past, CPA PFS was probably a good step above where at least the average CFP was. I would probably make the case now that they're getting a lot closer, particularly for newly minted CFPs coming in today who've been through the full curriculum, who've been through the experience requirements, who've gone through all the things that we actually require of CFPs today. And when I try to project it forward, frankly, I worry a little bit about where the PFS ends out. You look at data on things like the public awareness campaign that the CFP board has been running, where the CFP marks now almost have the same consumer awareness amongst the mass affluent as the CPA. Like, never mind the PFS. The PFS basically doesn't even show up on consumer awareness surveys. But the core CPA license is just barely ahead of CFP now.
I did not know that. I would have guessed awareness. CPA was way ahead of CFP. I know CFP's board's been making a big push lately, but
their full awareness, aided and unaided, has dramatically closed the gap. Now, just amongst the sort of mass affluent folks that would actually be likely to seek out a financial advisor, I suspect if you took a broader slice, you would probably see those numbers for CFP come down.
That's
because
fair.
Frankly, we as advisors don't spend a lot of time marketing to a large segment of the population that can't pay for our services or doesn't currently. But amongst the people most likely to use us, they're actually catching up. And so now we hit a weird space. Like, people know CFP and CPA, but very few people know CPA PFS. And it would make me worry if I was a PFS, whether at some point down the road, PFS just isn't helping. And I feel like even as a CPA PFS, I have to go out and get the CFP marks. And heaven forbid, when I go out to get the CFP marks, I found out I can't get them because the CFPs continue to move their standard forward to the point where you've fallen behind. So I'll admit, just looking how these things are projecting, there was definitely a point in the past where PFS was well ahead of CFP, certainly on standards and quality. I find them getting much more even now. We could probably debate a little bit about who's slightly ahead of who, because there's still a lot of rigor that just comes for anybody who's had to actually pass a CPA exam. That's a hard, serious exam with serious educational requirements behind it as well. But most of those have nothing to do with financial planning, and CPAs that come over to financial planning still have to relearn a lot anyways. So when I get CPAs that come to me today and ask which one should I go for, I frankly tell them I think you should be going for the CFP marks. Woe to you if you pick PFS, and 10 years from now, the consumer awareness is so high for CFP that AICPA eventually throws in the towel and says, we're just not going to support a designation that's not understood by the consumer public. Or worse, the regulators eventually decide that we need to regulate financial planning as a standalone profession and enshrine the CFP marks into legislation and make it a required standard. And now if you had a PFS all those years, you have to go out and get a CFP. Like, that's a possibility in some future. We're probably 10 years out, but that's a possibility in some future. So it worries me on behalf of PFS. Now, that being said, I will give a quick plug for the AICP also has a financial planning section. So they call it the PFP section, which is different than the PFS designation. The PFP section is basically a membership association group within AICPA for people who are CPA financial planners. The PFP section is a fantastic organization. Very good people. I find them to be top quality planners. The AICPA's PFP conference, I think, is the best quality financial planning conference for financial planning education out there. No great surprise, because they all have CPA as a base. You can go as a non-CPA who is a CFP, and many of the top financial planners do across the country now. So I think if you're a CPA financial planner, I would absolutely join the AICPA's PFP section so that you can be amongst your peers of CPA financial planners. But I think you're taking a risk by staking the PFS designation and not going to get the CFP marks. And I've talked to a couple of CPAs who basically said, I don't want to go get the CFP marks, so I don't want to have to deal with all the exam stuff. I think the PFS is going to be a little easier for me to get. And I'm like, yeah, but that's the point.
That's the point. And that's
a problem. Like, that's not where it was historically, but that's kind of where it's evolving now. And I would get worried about where that stands in the long run. And likewise, I mean, at some point, maybe the PFS will try to lift their standards up as well to stay ahead. But I don't know why the AICPA needs to get into a financial planning designation war with the CFP board, or why it's even productive for them to do so. I would just tell any CPA, if you want to do financial planning, get your CFP marks, join the PFP section, and be a CPA, CFP. Now you've got the two most recognized consumer credentials out there for anything that has to do with tax and financial planning. Be an awesome CPA, CFP who's involved in the AIC's personal financial planning section. And I think you've got the best of all worlds there.
And I think it's important to say that, the AICP is a wonderful organization. The PFS is a very legitimate educational, designation, or education in order to get the designation and the exams and all of that. Ultimately, though, NAPFA, FPA, we've heard them both say, we got on board as well at XY Planning Network to say, look, we've got to circle around the central designation. Every profession is circled around a designation, just like the CPA, just like MD for doctors, just like JD for lawyers. And while there are some kind of fringe designations out there, I'm thinking like DO for is technically a doctor of medicine, and yet very, very few people actually know what that is. And so while I'm actually not even, I believe there is a little bit of a difference in terms of the way they do their education, that sort of thing. They can act as MDs in most states, but we don't know who they are. We know MDs, and we see MD, we think doctor. And I think that ultimately many of us have this strong passion, this strong desire to turn financial planning into a profession, because we are not one right now. We like to act like it is. We like to act like what we hope it becomes. And the designation front is one of those pieces that we need to get circled around a central designation. If you ever hear me present at conferences, you hear me beating the drum of, look, we can't be a profession if we only work with rich people. And so there are a lot of different fronts that we're attacking in terms of how do we kind of centralize the messaging around what financial planning is? How do we actually make it available and accessible to all Americans, whether you have wealth or not, under different service models? And kind of pull this whole thing together so that we can push it into profession land instead of continuing to just be an industry that serves rich people.
And that's part of the key distinction there is just, all professions. When you actually look up like what defines a profession, one of the core things that defines a profession is a relatively high standardized barrier to entry, so that the public can clearly differentiate who are the qualified professionals and who is not. And the way that virtually every profession ends out emerging is that you get high quality professionals mixed in with people who say they do it but don't. And the only way that you separate them out is you put some kind of licensing or regulatory requirement in place. You have relatively high standards, and that becomes the screening process to ensure that only the people who serve the public are actually qualified professionals to do so. And as Alan said, like virtually every profession that becomes a profession has to rally around a central entry point, because you can't go to the public and say like, oh, the way you determine a professional is as long as they've bought one of these 17 different entry points. Like it doesn't work, because consumers can't keep track of all that. All professions converge on one as a baseline point of entry. And certainly when you look at the space, there's, I think, something like 6,000 to 8,000 PFSs. There are 73,000 CFPs. We've added more CFPs in the past 3 years than PFS has created in 30. And you just look at that dynamic and the compounding that's going on. And if I had to bet, are we going to become a profession someday? My answer is yes. And if I had to bet what's more likely to be the defining designation of the profession, it's certainly a CFP over PFS, not the least of which because you can't get a PFS without going through to get a CPA license, which functionally at the end of the day is not actually that related to financial planning. Like I even go through this. I'm a person that spends a lot of time on tax issues. I have a master's in taxation. I have a master's in financial planning. My undergrad degree, all my classes, 2 master's degrees, a boatload of designations. I cannot go get my CPA license. And the reason I can't get my CPA license is I would have to go back to college and take several credit hours of audit, because I never studied auditing, because auditing is not relevant in financial planning, but it is if you're going to be an accountant. And more power to accountants that do auditing and attestations of, but the issue, and like to me, like it just kind of highlights the point, like, yes, there's some overlap for some of what some CPAs do and where financial planning is, but ultimately they're separate things. And I just realistically, I cannot imagine that the future path to the financial planning profession is that all financial planning professionals in the future will be required to go to an undergrad program and take auditing classes, even if you're an experienced financial planning practitioner, because it's not relevant. It's not part of what we do as financial planners. And I just seriously question whether the long-term path to the financial planning profession is going to be through the accounting world. They just do a different thing. They do a powerful, important thing. Like I've got nothing against CPAs and what they do, but it's not the same as financial planning. And I don't think realistically it's going to be the professional path in the future. I hope that eventually we have a financial planning path that requires 150 credit hour educational experience like the CPA exam with masters in financial planning where you study the things that matter for financial planning. But I doubt it's going to be through the world of doing audit work and studying audit.
I like how you snuck that in at the end. That is something that would be fun to debate with some older school advisors that may not even have college degrees, since we didn't require it back in the day to be a financial planner. But yeah,
true. The undergrad requirement's only been in place, I think, 8 or 9 years. I want to say it was like 2005, 2006, maybe, that we put that in place for the CFP marks. But again, like, so when we go back 20 years, everybody who had a PFS had a graduate degree in accounting in order to get their CPA license first. And you could do the CFP with 5 classes, no comprehensive exam, and a high school diploma. So like PFS was way up there, and CFP was really far behind. And, you know, every year we're going through, the CFP has done a lot to lift its standards. I still think we have a ways to go. I don't like some of the recent changes we've done, but like the CFP has a very noticeable forward momentum. The PFS is not so much. It's been relatively flat, in part because the CPA is just such a significant base. But this framework that we had a decade or two ago, where the PFS was well ahead, just that gap is closed, and it continues to close every year. And to me, no offense to them, but that continues to make the PFS less relevant as a separate standalone financial planning designation. And I think gives us more opportunity to gather together around one, and the CPA financial planners will join AICPA's financial planning section, and and other fee-only advisors will join groups like NAPFA. And, you know, there can be lots of different association groups that serve us as professionals, but ultimately we have to convene around a central professional designation if we really want to stake ourselves as a profession. And CFP to me is the best horse we've got to bet on. It's not perfect, but I think it's the best one we've got to bet.
Agreed. Yeah, I think we're both on the same page. For any CPAs out there looking to get an education in financial planning, I would push you, and you would push them towards the CFP.
Yep. All right, but join your PFP section.
Good yes, people. Absolutely. All right, so switching gears a little bit, let's talk e-signatures. Are advisors successfully using this technology? How so? I don't think all the custodians are accepting them. Paperless online account opening is a real thing, but how is it achieved? So I love electronic signatures. When I first launched my firm, this was one of the things that I did because I said, I am not printing hundreds and hundreds of pages of account openings. I remember having a client that I was in Wisconsin. They were in California. I think we were opening 4 accounts. I think it was like 2 IRAs, 1 Roth IRA, and a traditional account. So we had beneficiary designation forms, all the account opening forms, all the transfer paperwork, everything. It was like 280 pages of documents to open 4 accounts. And I had 2 options. Option A was I print out 200 and whatever pages. I go through with those little stickies that say sign here, initial here, and we had a couple, and so there were documents that they both had to sign, so we had to be sure that we lined up who was signing which one. And so we're going to package all of that together. I'm going to mail it to them because I'm not going to ask a client to print 250 pages. They're going to go through it. They're going to sign everywhere. One of those little stickies got folded up in, I'm sure, and so we're going to miss a signature, and it's just going to be a nightmare. Or I'm going to print all of those documents to PDF. I'm going to upload them into an online document signing system, and I'm going to literally electronically place signature boxes and initial boxes where they need to go, and I can say husband, wife, and so only the husband can only sign his and the wife can only sign hers, and I'm going to email it to them. They're going to go through, and I think I had all of those documents signed within 5 minutes because the clients knew they were coming. They just got on there, signed it once, click, 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 done. So I don't think we need to preach the value of electronic signatures. Anyone that has used them knows just how powerful they are. But if you haven't yet, I highly recommend go out and grab electronic signatures. Even if you don't do this with client paperwork, adopt it in your practice just for contracts. And anytime anyone sends you anything with a signature, it just makes life so much more convenient. I would say the 3 big players, just so everyone knows, is DocuSign is the biggest player. EchoSign, which has recently been rebranded to Adobe Document Cloud because it's always been owned by Adobe, but they rebranded it into kind of their overall brand of document management. And then a new one that we've actually recently migrated to is called HelloSign. And I've been really impressed with it. It just comes in at a good price point. One of the things that in this question says about custodians accepting electronic signatures, I believe at this point, all custodians accept electronic signatures. TD Ameritrade and Schwab, and I believe Fidelity, I can't say on Fidelity, but I know TD Ameritrade and Schwab all accept through DocuSign. And they actually have their own kind of white labeled version of DocuSign that they can make available to advisors in order to sign paperwork. With the smaller custodians like Scottrade, Trade PMR, Shareholder Service Group, you can have a conversation with them directly. I personally always took the ask for forgiveness instead of permission approach. And now that I am no longer opening accounts, I can tell Shareholder Service Group this. No, it's very obvious when you send an electronic signature. There's no hiding it.
And they being that there's no piece of paper.
Right. They just email it to them. And it's like, oh, look at this perfect signature. And I just adopted two kind of rules of thumb. One was that there's a thing in signing documents electronically called a biometric signature. And so instead of someone just typing out their name and it creating a signature, they literally create a signature signing with their mouse, which for things like ACH transfers gives a way to match up signatures. So I always just did that automatically. That was just part of the workflow. And every system provides an audit trail, and you can just provide the signature audit trail, and that is sufficient. Electronic signatures have been upheld in all 50 states. They are considered legal signatures the same way, something in person, a wet signature is considered. So pretty much all the custodians are accepting them at this point. And if you have someone at a custodian that tells you it's not accepted, move on and try to find someone else at that custodian that will tell you it's accepted. But honestly, especially if you're signing on with a new custodian, if somebody tells you they don't accept electronic signatures, I'd move on to the next custodian, because if they haven't got on board by now, I would be worried about their future prospects in terms of technology in general at the custodial level. So that's my rant.
So one or two other items that come to me on this as well, and I admit I don't know some of the details on compliance issues. I don't know if every state that you're registered in terms of state RIA registration, if every state has accepted that you can do e-signature just for client agreements and such. I kind of feel like or hope that we're at that point now in the regulatory world, but just I would at least, anybody who's going to be a state registered investment advisor, I would double check with your state securities department or your compliance consultant just to verify that there are no issues with the acceptance of e-signatures for basically not like your account related paperwork, but the rest of what you do in your practice with engaging your
contracts,
clients.
Things like that. That's a good point.
Client engagement contracts and things along those lines. Yeah, I suspect any states that aren't allowing it, that's going to be resolved within a year or two, right? E-signatures going mainstream. I can pretty much in most states now sell my house without ever pulling out a pen. So at some point we'll be able to pay an advisor too. But yeah, just I would at least double check that just to make sure, because I don't for certain know all 50 states are completely on board with every kind of piece of paper being paperless now.
Yeah, I went through an audit in Wisconsin. I've had conversations with Montana regulators, both, Montana not necessarily known as the most tech forward state that you could move to. And had no issues with it. But again, there's 50 sets, or I guess 51 sets of regulators plus the SEC. So, it's worth that conversation, but you probably won't run into any issues, but it's certainly worth asking. Okay, last question of this episode. And I think this one's really good. We may run a little over our typical hour for this one, but I think it's worth it.
So it's not a yes or no question.
This one is not a yes or no.
Darn it.
For new owners out there, strategies to get through the valleys of business ownership without quitting. But to take it a step further, how do you determine when it may be a good time to give up the dream and go get a job at a firm? So
that is not a yes or no question.
This is not a yes or no question. Before we jump into this, I will redirect people back to a couple of previous episodes. One was with Katie Brewer. And then another, that was episode 19. And then another was with Justin Rush, which was episode 21. Both of them, they are on their second RIA. So they started RIAs. It didn't work out. They ended up going back and getting jobs, and then ended up going out again and opening up kind of an RIA second time around with new education, new learning, new experience, more capital kind of thing. And so I want to preface this by saying, if you want to hear some stories about how advisors have, ultimately closed shop and then kind of took another swing at it, they could. So I guess, I don't know, any thoughts initially? Because it's a great question in terms of, one, how do you deal with the valleys? And then two, how do you know when you got to take a step back and be done for a while?
So I'll start with dealing with the valleys. I mean, frankly, my simplest, most straightforward answer about how do you deal with the valleys, social support from other human beings who can help lift you back up out of the valley. So
true.
I think we talked about this in a prior Mailbag episode, the importance of having your spouse on board if you're married, because frankly, there will be valleys, there will be tough times, when you only had 6 clients after having gotten 47 no's, and then one of your 6 says, I've decided I don't want to keep working with you. And you go, shit, I'm back to 5. And just, it's a brutal setback because that was 16% of your revenue that just went out the door when you lose a client and you only have 6. Just those dynamics, you need a spouse that's, well, if you have a spouse, you need a spouse that's going to be supportive. I was going to say you need a spouse that's supportive. It doesn't mean so you shouldn't launch your practice until you go get married and insert a spouse who will support our entrepreneur. But yeah, you need a spouse that's on board, and we don't have to go entirely down that rabbit hole. We'll link in the show notes to the prior Mailbag episode where we talked about that if you're wondering if your spouse is on board, or a little bit more about that conversation. But you need a social support group. So starting point, frankly, is spouse, and even, friend or close friends. That can be a mentor if you've got a mentor relationship, someone who's walked the path and is at least some point further down than you, who can just help reflect back and lift you up a little bit. And this is a place for study groups, mastermind groups, depending on what you want to call them. I've written about these on the site. We have articles up on XYPN site.
For anybody that comes... Just released an article on this. So.
Oh, yeah, we just posted one. And frankly, for anybody that joins XYPN, if you come in and you're launching a firm, we literally put you in what we call a launcher group, which is a study group of other advisors that are launching around the same time as you. So that you've got a peer group to start going through this process with, so that you have a place where you're like, hell yeah, I just got my first client and I need some people to give me a hell yeah in response. That is what your study group is there for. And when your 6th client leaves and you're back to 5 and you lost 16% of your revenue, your study group is there to help pick you up as well. And you do that for each other. You just recognize the power of social support. You shouldn't go through this alone. You don't need to go through this alone. I think you're kind of nuts if you want to go through this alone. You just don't do that. I mean, I guess there's a tiny subset of people out there who are so freaking entrepreneurially driven that even with no social support system, they're just going to power through. But for the rest of us normal human beings, where we have highs and we have lows, and the lows can hurt a lot, social support, create opportunities for yourself to get supported from others, spouse, friend or friends, mentors, failing anything else, study group of others that are going to go through this with you, who can be there to support you.
Yeah, and I think it's really important to know that the valleys will come. I mean, there's just no avoiding them. I mean, entrepreneurship is incredibly rewarding, and we all know that with the potential of reward comes risk, and that risk is failure. The risk is the valleys. I'll never forget the day I woke up in the middle of the night in a cold sweat thinking, I can't pay rent next month. I'm done. I mean, this is done. Now, fortunately, I was able to find a way to power through that and find a way to make enough money to make rent happen. But that is entrepreneurship. Jude Boudreau from Upperline Financial, who we are going to have on the show here shortly, Jude told me one time, he said, entrepreneurship means the highest highs and the lowest lows you've ever experienced, sometimes all in the same day. Okay. And it's a reality of entrepreneurship that, we lose that client and it takes us back to 5. And then someone calls us later in the day and says, yeah, I'm ready to sign on. And you can have that big moment of loss and that huge win just all at the same time, which is, it's an emotional roller coaster. And I'll say that I am where I am because of my study group with FP Hackers, who you've heard about in previous episodes and met pretty much all the members. That's why I've made it through some of the trials and tribulations. And I think that they would all agree that it has been incredibly instrumental. The other thing that I'll tell you is that we have a great article that Matt Becker wrote. Goodness, it's probably in May of 2014. Have to find it so we can link to it in the show notes, talking about minding the gap. And it is this gap of understanding that, sometimes we jump into this concept of entrepreneurship because we see success stories. We see the people that have been on XYPN radio and we see their stories and we think, okay, that's what I'm building, that I'm going to have that. But you don't get to see the boring parts. You don't get to see the lows because we really only publicly express the highs. And so I think sometimes we can be fooled into thinking there aren't lows.
And I know there's been some written about this as well in other circles, like our world of social media, where, classically most of us only ever like to project the good stuff and not the bad stuff. That social media, if anything, has just amplified this effect where you only see the good stuff that is happening to people that people are going through, and you don't see the bad that they're going through behind the scenes. And we get sometimes these very distorted views that as though, like business success and entrepreneurship success and just being successful as an advisor is this like straight upward sloping line progression for everybody else except me. And I feel like I've got all these highs and lows that goes along with it. It's like, no, everybody else does as well. They just only post the highs. They don't post the lows, or apparently if they do, Facebook screens it out because they don't like to let you see everybody else's negative emotions anyway. So you just recognize that dynamic that everybody's going through it to some extent, but you do need some others that you can share and connect with around it who can support you and who you can play that role of supporting for them. And to me, that's the power of study group. And likewise, I have a study group that I've been involved with. We're literally coming up beginning of next year on our 10-year anniversary. There are 10 of us. We've been together for all 10 years. No one's left. No one's added in. Incredibly stable group. And we've gone through those highs and lows with each other. People that have bought firms, left firms, gotten fired out of firms, started their own practices. You just in that first 10-year window.
And don't forget the personal side too of get married, get divorced, have babies. I mean, whenever you're an entrepreneur, the personal side and the professional side, tend to start bleeding together. So Carl Richards gives a great example, and he did this at our conference back in September, but he was talking about the power in terms of marketing. But I think it's applicable here where we say, if you have a penny and you double it every day for a month, how much money do you have at the end of 31 days? Well, the answer is $10 million. But after a week, you only have 64 cents. And unfortunately, what we see a lot of times are people go from day 30 to day 31, where they go from 5 million to 10 million. And it's this huge excitement. And that's where we all want to be. But we didn't really watch them go from day 1 to day 2 to day 3, where they're going from 1 to 2 to 4. And they're doing the things that are really boring, that are really hard, that are really challenging in order to get to where they had day 30. Because I will tell you, you cannot get to day 30 without experiencing every single day before it. But moving on to the second part is, so you've been through these highs, you've been through these lows. How do you determine when to give up the dream? How do you decide, it's not working and I need to go back and get a job? Well,
I suppose failing anything else, the point you can't make rent is usually a good...
Certainly the financial side
moment.
Of things.
Yeah. So, and I mean, I guess that's kind of the first distinction, right? There's the financial side, right? Like for some people, the dream has to end because there are bills to pay and the business just hasn't grown to that point. And then frankly, there are some others out there where maybe they've done enough saving, they've got a spouse to support, they've got some other means out there. And so the decision point about when and where to kind of call it a day on this business, it's not going to be the financials that drive it. It's got to be some other factor.
You may find you don't enjoy owning a business. I mean, I think that there's some misconceptions out there about what we do on a daily basis as the firm owner, especially if you're solo. And I definitely know advisors that get into it and go, you know what? This is not for me. I really didn't realize all the stuff I'd be doing. I just want to do planning, which is not a good attitude to have as the owner of an RIA.
Yeah. So, in terms of where you go, so financial constraints aside, I mean, I don't know. I feel like some of this basically gets into, so how long does it, if it's going to be working, how long does it realistically take so you can figure out whether you're quote unquote on track or not after you're a couple of years in. So, having lived through a bunch of business growth cycles myself in a lot of different businesses in the advisor world, I find like when you're really digging into an advisory business that the real momentum basically takes 3 years before you really tend to see traction. Every now and then someone breaks out a little faster, but I find most often it's 3 years. And basically year one is just a grind, an excruciating grind. You're fighting for every prospect, every client. You're just trying to get out there. Year two is basically like year one. The good news is there's some revenue because there's some people you worked with last year. You'll lose one or two, which is going to suck, but you'll keep most of them. And you'll just keep grinding out one more and one more and one more. And you'll be trying to make some forward progression. And then somewhere after like 18 to 24 months, you'll get the first referral or two that comes in. It might be from an existing client you've been working with for 6 or 12 months. It might even be someone that you don't actually work with, but you're getting a little bit known now in your niche. And now that they've seen you interacting in this niche for 2 years, they're like, all right, it looks like this guy or gal, like they're actually going to stick around, seem to kind of know their stuff, been involved with them a little bit, trust them. I'm comfortable with them. I don't have a need to work with them personally, but I'm going to refer them. I'm going to refer them for someone else that I know that I think would benefit from their help. And suddenly, as you get close out year 2 and you get into year 3, like some referrals start coming in, a little bit of actual compounding comes in. So your business grows by more than just the number of new people you can go out cold and try to bring in as new clients. And then once you kind of get past that 3-year mark, often I see that the compounding starts to accelerate, starts to pick up, it starts to get better. So
are you saying if after year 3, you're still in this, like, feel like it's a day-to-day grind and you're not experiencing that, then that might be an indicator that things are moving a little slower?
Yeah. And frankly, if you're coming to the end of year 2 and you haven't gotten a single referral, nothing's come inbound, not even inquiries, you already have a significant problem with your niche and marketing and positioning. You're too general, and that's why no one can figure out how to refer you, or there's some issue going on. Now, because of this, it also means that in the first year, which is really the hardest, you have to even be careful about how you measure success, because it's too hard to measure success by clients because you're kind of the numbers are too small. They don't always average out. Like, I could take 2 advisors that do basically the same thing the same way, and just based on dumb luck about who talks to who on the right day or not, like one of them could have 10 clients and the other one could have 6 clients. It's not because the one with 6 is screwing up and the one with 10 is awesome. It's because they're both basically doing the same good process and just
closed a couple extra clients.
Fate smiled on them, right place, right time on a couple of people, and suddenly one person popped ahead with more. So for the first year in particular, I find like you've got to measure the activity more than the results, because the results are just too lumpy and uneven. You're like, holy crap, I had 2 clients in a month. This is amazing. It's like, yeah, but those are your first 2 clients in 3 months because there was a little bit of a dry spell. And like your business hasn't turned a quarter because you get 2 clients in a month, because in your next 2 months, you might have zeros again while you're still building momentum. So measure the activity and focus on the activity and make habits out of the activity. So are you going to networking meetings? Are you doing prospect meetings? Are you reaching out to people? If you're writing a blog, are you writing regularly? Are you looking at the traffic? Is it growing? Are you getting increased subscribers? Like whatever your marketing process is, measure the activity and make sure that the activity is growing. And I find in year 1, you're mostly measuring off activity and maybe a couple of results that come in. By year 2, you're starting to measure on results. By year 3, you should be looking for the compounding effects. And if you're not seeing those at some of those milestones, that's also the hint. Now, the flip side to this as well, if you haven't given yourself a 2 to 3 year runway to really start seeing any level of momentum, you're not realistically giving yourself enough time. And
if you're having this conversation after 3 to 6 months, it's going to be tough.
It's going to be really tough. And if you're coming into this and you're trying to figure out like how long is it going to take for me to get going, there are some people out there who break out really fast, and we've talked to 1 or 2 on the show, and just people who are pretty solid performers. I mean, we've certainly seen people that have managed to get up to $100,000 of revenue by the end of their 2nd year, heading into their 3rd year, and you scrape out a little bit of expenses, and like that's some pretty good cash flow going, at least for most people out there. But and then it compounds growth from there. But it takes a while. I mean, it takes a while. If you're looking at coming into this and you're going to be in trouble in 18 months if you don't have a ton of clients in business, you're in trouble on day 1 even launching this business. You're not giving it enough time. And again, I think this is also the point, like, because you're not going to come out of the gate immediately and have realistically a massive avalanche of clients. It's going to take time. This, again, is why your study group, your social support network is important, because I know you're totally awesomely enthusiastic and excited about launching your business, and I'm totally psyched for you, and really I am, but no one keeps that level of energy for 18 straight months before you're starting to see results and momentum building. There are going to be lows. Just even the most optimistic person has to have pauses from time to time. And so be prepared for those. Have your support system.
So if you're in this position and you're taking a look at this and you're kind of questioning it, should I continue on? Should I fold back into a firm? Just a couple of thoughts. One is, remember that failure in this instance is that the firm didn't work, it didn't make, and you're going to go get a job probably doing exactly what you were doing before you launched your firm. There's not a lot of industries and professions that are just so supportive of the fact, and part of it is just we need young talent in the profession. Part of it is the fact that you learn so much as a business owner that whenever you go back and you get a job, you're extremely valuable. And you may find not only are you in a position similar to where you were before, you may find you are in a much higher position than you were before. You may find that instead of coming back in as a junior planner or a paraplanner, they say, hey, you've been working with clients. Yeah, you didn't grow the firm, but you had 20 clients that you're bringing to the table. Suddenly you're a lead planner because you're bringing client relationships with you. You may find that there's a buyout opportunity that you might actually be able to monetize bringing whatever base of clients, because I don't know anyone that has 0 clients after a year or two. You'll be able to bring that into the firm. And again, go back, if you're in this position, go back and listen to Justin Rush's interview, because I think he made some excellent points in there about kind of failing the first time. And he failed very fast because he launched in the middle of the market downturn. But looking at how valuable his experience starting a firm actually was, because the firm that he was moving to actually needed that expertise and that he was highly employable. I think that's another fear. People think, oh, no one's going to want to hire me. I think you're actually highly employable after you have started your own firm. And allow yourself to refocus, and focus on what are you good at? What were you not good at? Were you not good at marketing? Go get a job and go get that education. Go learn how to market. Go learn how inbound marketing is. Go through Digital Marketer or Kristen Harrod's Lead You Love program or whatever. Go get the education for the next couple of years and maybe give it another go in the future, and that's just part of it. But, I would encourage you to know that no one judges a business owner for failure. If there was no failures out there, we certainly, everyone would own a business because, I think we all know the benefits of it. It's a risky venture, even in financial planning, even though we kind of talk about it as if it's a given, like, oh yeah, just go start your own firm. You'll be fine. That's probably not fair of a way of framing it, because it is tough. It's hard and it is a grind. And if it's not working, it's okay to admit it's not working and go do something else and then come back to it one day in the future.
And I think that's so crucial, just to recognize like the sort of the fallback, the what if it fails is, we're still in an industry with a talent shortage, especially for experienced advisors. I can tell you as someone on the other end, like as a partner in an advisory firm that hires advisors as well, we like people who've been out there and tried to start their own firms. Even if it didn't entirely work out for them, you have a perspective about what it's like to do that frankly, like what I hope as an advisory firm owner is, all right, maybe it was a bit tough for you on your own, but because you've done that, you had a hunger for it, you had a desire for it, and you got some experience with it. If I bring you into my firm with the tools and resources and kind of size and scale and brand that we have, I'm hoping that I can help make you more successful in our advisory firm. So like even as a firm owner, I actually, for anybody that's out there, like, tip 101, how to get a job from my firm, if you ever want one, I am more interested in you after you've gone out and tried to create a firm, even if it failed, than I am when you're about to leave your firm, because there's value that is such a powerful learning experience for anybody out there as an advisor who ever wants to help grow a practice their own or one that they work in and be rewarded for it. It's such a valuable skill set, and it's so hard for us to actually teach that, like, I think your odds of getting a job from any smart firm owner are better after you've gone out and tried this than they were when you were on your own. Not that you should like quit your job and do this just so you can go get another one. That's still a bumpy path. But just recognize like your fallback options are not bad in today's industry. They might even be better than they were when you left your original firm to start this adventure.
Yeah, I mean, I never got more job offers or merger offers than in the 6 to 12 months after I'd started my firm, and certainly was not quote unquote successful. But I mean, the offers started rolling in, sometimes in a couple of cases from firms that didn't hire me. And I had actually interviewed with them when I started my own firm. Then they got interested. And it was because you're suddenly bringing a different skill set. You're no longer the junior planner or junior advisor, associate advisor, whatever title we want to call it, looking for a job. Now you're the person who has taken the initiative to go start a firm, understands what it takes to run a firm, because there's nothing more valuable to a firm owner than somebody who understands how the firm actually works, and that there is bookkeeping and there is compliance and there are marketing needs and technology needs and all these other pieces. So All right, Michael, this was fun. We actually got to more questions than normal, mainly because we went 20 minutes over our normal time. But you know what? People have been clamoring for more content, so they'll just get a few longer episodes with the two of us instead.
All right.
So thanks, everybody, for joining us. We will see you next time. And be sure to submit questions to us through our VIP community at xyplanningnetwork.com/VIP or email us at radio@xyplanningnetwork.com. Thanks, everybody.
Thanks, everyone.
Oh, man, that was fun. I always love these episodes. They're just so much fun to get in and answer listener questions again that, we may not ever even think to cover. Most of those were topics that would never come up normally on the radio on any of our episodes with our guests. So it's always fun to get those in. So again, email us your questions at radio@xyplanningnetwork.com or join our VIP community at xyplanningnetwork.com/VIP, where you can ask questions and hopefully get on the air. And if not, still get your question answered there inside the community by either Michael or myself, as well as our community of other listeners. So this month's episodes were brought to you by TD Ameritrade Institutional, which provides comprehensive brokerage services and custody services to more than 4,000 fee-based independent registered investment advisors. Their advanced technology platform, coupled with personal support from dedicated service teams, allows investment advisors to grow and manage their practices more efficiently and effectively while optimizing time with clients. They provide a robust offering of products, programs, and services designed to help advisors build their businesses and do the best job possible that they can to help their clients with their financial goals. Remember that you can learn more about what TD Ameritrade is working on at xyplanningnetwork.com/23. Thanks again for joining us today. We'll see you next time.
You're not alone, and you're not crazy. It's scary starting, building, and growing your own financial planning firm. And that's why we put together a free private community just for you, the Cutting Edge Financial Planner. Go to xyplanningnetwork.com/VIP or text XYPN Radio to 33344 and join a network of thousands ready to change the lives of Gen X and Gen Y clients.